You think you understand the chart. But what if I told you that every candlestick pattern you see has already been manipulated before you even move your mouse? Picture this: a hedge fund trader, a room full of screens, and one mission: make your eyes see exactly what they want you to see. While you think price is just moving, they're layering invisible signals over the market. Signals that trick your brain the same way a magician tricks your eyes. It's no accident you often buy too late or sell too early. It's biology plus psychology plus billions of dollars in algorithms working together to distort your interpretation. In the next few minutes, I'll show you how to cut through the noise, read what's really happening, and develop the one skill that separates the consistent winners from everyone else. But first, you need to know who's actually drawing your chart. You've been taught to read the chart like it's gospel. Support here, resistance there. Breakouts mean strength, breakdowns mean weakness. But what if the chart you're looking at isn't reality at all? What if every candle, every volume spike, every textbook pattern you've memorized was planted there by people who don't just want your money, they want your belief? Welcome to Discipline Trades, where we rewire your brain so you can trade like the top 1%. This is not a pattern recognition tutorial. This is a demolition job. We're going to tear down every false belief the market has programmed into your brain, and then rebuild it with a lens that actually sees the truth. Because here's the uncomfortable reality: charts don't tell you what's happening. They tell you what someone wants you to think is happening. And unless you learn to read past the chart, you'll always be reacting to the story they wrote for you. In the next hour, you're going to discover the 21 psychological and technical manipulations that make charts lie and the counterintelligence tactics professional traders use to decode them. I'll show you why breakouts are usually invitations to lose money, how volume data can be more misleading than price, the hidden footprints that give away institutional intentions, and the one reading technique that doubled my win rate in less than 60 days, which we'll get into at number 5. By the end, you'll never look at a chart the same way again. You'll stop seeing candlesticks and start seeing motives. Before we start, drop a comment below. Have you ever taken a trade just because the chart looked good and it blew up instantly? Your honesty might just save someone else from making the same mistake. Chapter 1: The Mirage Effect. How charts tell the story they want you to see. You think you're seeing the market. You're not. You're watching a movie scripted, edited, and designed to make you react on cue. You sit at your screen, price grinding higher all morning, and then comes a pullback. It kisses the moving average, the candle bounces, volume ticks up, and suddenly everything in your body screams, "This is the moment." You click buy. The price pops for a few seconds and then collapses straight through your stop. You tell yourself it's bad luck, maybe the market turned against you, but it wasn't luck. It was a mirage, an image designed to look like opportunity, timed perfectly to extract liquidity from traders like you. That's the trap most people never see. Humans are wired to find patterns. We look at clouds and see shapes. We look at charts and see meaning. The people who actually move markets know this. That perfect head and shoulders, that clean engulfing candle, that breakout triangle, they can all be manufactured. And when thousands of retail traders see the same picture at the same time, they pile in. That wave of orders creates exactly what the big players need: liquidity to exit their own positions. Your brain never even gets the chance to fight it. Neuroscience shows the visual cortex reacts before the logical mind can intervene. You don't analyze the setup, you feel it, the same way you feel a magician's sleight of hand before you notice the trick. The chart shows strength, your mind completes the story, and by the time the candle flips into a trap, you're already inside. Think of a chart like a Hollywood set. From the front, it looks like a solid building. Step behind it, and it's just a painted wall held up by beams. The market works the same way. Volume spikes that are nothing but algorithms trading with themselves. Bounces manufactured by pulling liquidity. Breakouts triggered with a burst of buying that gets dumped into once retail floods in. Every candle has a backstory, and most of those stories are fiction. I'll never forget the small cap breakout in 2020. Textbook ascending triangle. Volume climbing every day. Clean break with a 15% gap. Social media went insane. Everyone piled in. 3 hours later, the stock was down 30%. Later, Level 2 showed the truth. Just 2 high-frequency desks triggered the breakout with a coordinated burst of buying. The second retail orders chased the move, those same desks sold into it. The chart looked like opportunity. Behind the curtain, it was just a liquidity harvest. That's what most traders don't get. Charts aren't just data, they're weapons. Every fake breakout, every too clean setup is bait, and bait only works if it looks delicious. Institutions don't need to outsmart you. They just need to feed you the story you already want to believe. Once you buy into the picture, you give them your order flow. And if you keep reading charts like they're truth, you'll keep playing the role they've written for you. The only way out is to stop treating setups as gospel and start asking who benefits from them existing. Look at volume differently. Is it organic? Or did it appear in one manufacturer burst? Zoom out first, because institutions play on higher time frames while traps live on lower ones. Study liquidity. Where will the stops sit? And whose game is served if they're triggered? And above all, stop rushing. Give any breakout 15 minutes to prove itself. You'll be stunned at how many unravel in that window. If you really want to rewire how you see charts, build a Mirage Journal. For a month, every time you spot a setup that looks perfect, screenshot it, predict what will happen, and wait. Collect your own library of traps. After 50 examples, your brain starts recognizing the tells automatically. The truth is simple. The market isn't the mirror, it's a stage. The actors are pros. The props are your favorite patterns, and the sooner you stop taking every candle at face value, the sooner you stop being the target and start becoming the hunter. Chapter 2. The False Volume Illusion. When big money isn't money at all. Every trader's been told, volume confirms the move. But what if the volume you're seeing isn't real at all? You spotted a sudden surge in price, a matching spike in volume. Textbook confirmation. Every guru's voice echoes in your head. Volume plus breakout equals green light. You hit buy. It rips for 2 minutes, then collapses. That wasn't big money piling in. It wasn't confirmation. It was smoke and mirrors. In the professional world, this isn't even a secret. It's called wash trading. Buy and sell orders fired back to back at the same price thousands of times a second, creating the illusion of activity without any actual commitment. On your chart, it paints a screaming green bar of aggressive buying, but under the hood, it's nothing more than 2 bots high-fiving each other. Even in more regulated markets, there are tricks. Iceberg orders split massive positions into tiny, rapid bursts, making it look like endless demand is flowing in. The effect is the same, a volume spike engineered to lure you in. Why bother faking it? Because liquidity is oxygen for institutions. If they want to unload millions of shares, they need someone to buy. And nothing attracts retail faster than the illusion of urgency. You think you're riding the wave. In reality, you are the wave, the liquidity they needed to cash out. The scale of the problem isn't theoretical. Back in 2019, Bitwise Asset Management submitted a report to the SEC claiming 95% of reported Bitcoin trading volume was fake. They showed data from 81 exchanges with impossible patterns, identical trade sizes, repeating every second, 24 hours a day, without a single break. One exchange claimed $480 million in daily trades, but the actual blockchain withdrawals showed only 4 million leaving the exchange. The rest was fiction. Retail saw big money coming in and chased it. The only thing real was the dumping that followed. Your brain is wired to fall for this. Volume spikes hijack the survival circuits that equate urgency with scarcity. Everyone's piling in. Don't get left behind. It's the same reflex that drives crowds into a store during a Black Friday rush. Institutions understand this. They don't just manufacture technical setups. They manufacture emotional urgency, the kind that makes you click without thinking. But not all volume is fake. The difference is in the texture. Real institutional pressure doesn't vanish after one bar. It leaves footprints steady, relentless movement across multiple candles, sustained activity that persists long after retail enthusiasm would have died out. When gold broke above $2,000 for the first time in 2020, volume didn't spike and fade. It stayed heavy for days as institutions reallocated portfolios. That kind of commitment is hard to fake. and it's the kind you want to follow. The trick is learning to wait. Most false spikes reveal themselves if you give them just a little time. Let 3 candles pass. If the price holds, if volume sustains, there's weight behind the move. If it collapses back into the range, it was just bait. That single adjustment has saved me from dozens of breakouts that looked irresistible in the moment but died just as fast as they appeared. If you really want to sharpen your instincts, start dissecting volume like a surgeon. Track 20 setups. Screenshot the spike. Know the time frame. Record whether there was real follow-through, and log the outcome. Within weeks, you'll notice the difference between organic pressure and manufactured noise. Your brain will stop reacting to every green bar as if it's gospel, because you have evidence of how many are lies. Volume is the heartbeat of the market. But just like a hospital monitor, that heartbeat can be faked. If you mistake a manufactured pulse for the real thing, you'll end up making decisions based on fiction. Learn to see through it, and you stop chasing ghosts. You stop being the liquidity, and you start following the real money. Chapter 3. The Stop Hunt Illusion. Why your stop loss is their entry signal. If you've ever been stopped out by a few cents only to watch price rip in your original direction, you've been hunted. It feels personal, doesn't it? You did everything right, you identified support, waited for confirmation, placed your stop just below the obvious level, exactly like the textbooks say. And then the market dropped, tagged your stop to the cent, and ripped 3 times your risk in the very direction you had called. That's not bad luck. It's not coincidence. It's design. Because big players need liquidity. They can't move millions of shares into the market without willing sellers on the other side, and the easiest place to find those sellers is in the cluster of retail stop losses. Stops are predictable. Everyone tucks them under swing lows, above swing highs, or right at the round numbers. That's why price runs through them before moving on. It's not chaos, it's harvest. Here's how it works. Algorithms scan the order book and recent action for dense stop clusters. A relatively small push drives price into that zone. The cascade begins as stops trigger into market orders, accelerating the move. And in that split second, the bigger player is there, absorbing the flow and filling their real position with minimal slippage. Then price reverses, because the trap is sprung and the few that drove the flush is gone. It's happened on every market you can name. In January 2017, GBP USD dropped 60 pips in under 30 seconds during London hours, no news, no reason. Retail forums screamed WTF. But there was a reason. Just below 1.2200, stops were stacked. A major bank drove price down, cleared the board, then reloaded. Within minutes, the pair was trading higher than before. Retail called it manipulation. The bank called it entry. What makes the hunt sting isn't just the loss, it's the psychology behind it. When your stop hits, loss aversion kicks in, that primal need to end pain at any cost, relief floods in, then anger. And that anger is the bait for your next mistake, the revenge trade. You sell into the bottom or chase the reversal you just missed. Either way, you've donated liquidity twice in the same hour. The only way out is to stop playing the obvious game. If your stop is sitting where everyone else's is, you're not protected, you're exposed. Place it beyond the point where the idea is truly broken, not just beneath the textbook low. Make it ugly. 1.1993 instead of 1.2000. 1.1987 instead of 1.1980. Better yet, add a volatility buffer, widen the stop by 1.5 times the average range. It feels uncomfortable, but discomfort is the point. It makes you invisible. And once you see the hunt for what it is, you can flip it. Instead of fearing the flush, you stalk it. Mark the level where everyone is hiding their stops. Wait for the spike into that zone. Watch the immediate snapback as the cascade exhausts itself. That's not danger. That's your entry. I've seen it countless times. Nasdaq futures drifting all morning, price grinding toward yesterday's low. You know what's sitting just beyond that level. A fat cluster of stops. Then one candle rips 12 points through the floor. In the next 15 minutes, it rockets 40 points in the opposite direction. Why? The stops fed the institutions. The selling pressure evaporated, and only buyers remained. Traders who recognized the hunt didn't just avoid being prey, they rode the reversal for a clean multiple without taking any heat. Once you start logging them, the patterns become undeniable. How far price spikes beyond the level, how fast it snaps back, how often the accidental flush happens right where stops were most obvious. The truth is harsh but liberating. Your stop loss isn't your invisible shield. It's someone else's target. And the sooner you stop treating it like a secret line in the sand and start seeing it as a glowing beacon of liquidity, the sooner you stop being prey. Better yet, the sooner you'll turn the hunter's game into your own. Chapter 4. The Time Frame Trap. Why the lower you go, the more the market lies. If you think dropping to a smaller time frame will get you in earlier or give you more setups, you're falling for one of the most expensive illusions in trading. It feels logical, more signals must mean more profit, but in practice, it's the fastest way to bleed an account dry. On a 1-minute chart, most of what you're watching is meaningless microstructure. Bots firing off, high-frequency players probing liquidity, random noise that has nothing to do with the true trend. You convince yourself you're reading the market, but really you're reacting to shadows. Even when you manage to catch a move, the spread and slippage eat into such a big slice of your small targets that you're fighting uphill before you even start. And this is exactly where algorithms want you glued to a chart they can push around at will. I've watched traders burn themselves out here. One guy came in scalping Euro USD on the 1-minute, convinced he could turn frequency into consistency. 300 trades in the first month, down 12%. 280 the second month, down another 8%. By month 3, he was drained, both financially and mentally. The problem wasn't his setups. It was that the market he was looking at didn't matter. When he finally moved to the 1-hour chart, everything changed. His trades dropped to a few dozen a month, his stress evaporated, and his win rate climbed without touching a single rule. That's how timeframes really work. The 1-minute is like staring at pixels, desperate to guess the picture. The 15-minute shows shapes, the daily reveals the full image. Institutions build their biggest positions on daily, weekly, even monthly charts because those can be faked easily. It's too expensive to manufacture conviction across that scale. But on a 1-minute chart, they can shove price wherever they want for a few seconds, trigger your fear, scoop up your liquidity, and move on before you even know what hit you. And the cost isn't just money, it's mental capital. Every candle on a tiny time frame demands a decision. Within the first hour, you've burned through willpower, your cortisol spiking, your brain's fried, and your discipline's shot. You call it fast trading. In reality, it's decision fatigue dressed up as hustle. On higher time frames, you get to breathe. You have minutes or hours to evaluate, plan, size, and execute without the panic of constant micro movement. The numbers prove it. Track enough traders, and the curve is brutal. On the 1-minute, 95% lose. On the 5-minute, it's 90. By the 1 hour, it drops to 70. Daily charts, 40. Weekly, only 20. It's not about who's smarter, it's about who's playing a less rigged game. And the difference is night and day when you see it firsthand. I coach a trader who used to chase Tesla intraday on the 15-minute. She moved to the daily and stopped reacting to noise. Instead of grabbing scraps from fake spikes, she caught entire breakouts that lasted days. Her average hold time stretched from a couple hours to nearly a week, and her returns exploded. In her first quarter, she made 43% on just 12 trades. If you want to feel the shift, force yourself to step back, cut off everything under the 1-hour chart for a month. Set alerts, walk away, and only act when the bigger picture speaks. At first, it'll feel like you're missing out. But by week 2, you'll realize the only thing you're missing is noise, the very noise that was designed to chew you up. The lower you zoom, the easier it is for the market to lie to you. The higher you go, the cleaner the truth becomes. And once you see that difference clearly, you'll never look at a 1-minute chart again without recognizing it for what it really is: a distraction, a trap, and the perfect feeding ground for the players who profit off your impatience. Chapter 5. the institutional footprint, how to see the big money before it moves the market. The biggest trades don't happen in the breakout you see on your screen. They happen long before that, in silence, in shadows, when almost nobody's watching. Most traders chase the explosion, the giant green candle, the gap that lights up the scanner. By the time retail piles in, the pros are already sitting pretty. They don't buy breakouts. They build positions. And because they can't move millions of shares in one swipe without sending price vertical and wrecking their fills, they do it slowly, quietly, methodically in what looks like boring, sideways chop to you. At first, it doesn't even look like anything's happening. A dip under support here, just deep enough to trigger retail stops. Panic hits, weak hands dump, and all that liquidity gets absorbed by bigger players who don't flinch. Then comes the sideways grind. Price moving in a tight box while heavy volume quietly passes back and forth. It looks dead, but it's not, it's absorption. Every dull candle is inventory being stacked. And right before the breakout, that final push lower, the ugly spring, the move that convinces retail the bottom is falling out, they dump, institutions load, then, and only then, does the breakout you recognize show up. By that point, the real money is already in. I watched it unfold in Apple during March 2020. 2 weeks of dead air between 60 and 64, nothing but chop. Then a dip under 60, just enough to wipe out every stop. Retail puked it away. 24 hours later, price was back near 65, and over the next 6 weeks, Apple ripped to 80. The chart screamed breakdown, but the tape whispered absorption. Most traders never heard it. That's the thing, you can see the footprints if you know what to look for. Heavy volume with no progress. Sharp fakeouts around obvious levels. Price testing, support or resistance over and over but refusing to break. These aren't random moves. They're tells, signs of someone bigger loading the truck. It's like watching a warehouse being filled. They stockpile inventory during the chop, then release it into the markup when demand finally shows up. And when they're done buying, they flip the script and start unloading distribution. Looks exactly the same but in reverse. Bitcoin's 2021 top was textbook. From March through April, it danced between 58 and 61, while Twitter screamed new highs. Retail was euphoric, but the whales? They were moving coins quietly onto exchanges, unloading into the excitement. By April 14, it hit 64.8. A month later, it was 30. Sideways to retail meant ready to explode higher. To institutions, it was the perfect exit. The footprint is always there if you stop chasing fireworks and start studying the shadows. Boring sideways action with suspicious volume? That's the clue. The false break that reverses instantly, that's the trap. And the reversal from that trap, that's the entry. You don't set your stop where everyone else does, right? At the obvious level. You put it beyond the extremes because institutions love to retest the zone before moving on. Once you start logging these ranges, marking the fake breaks, watching what comes after, you'll see how predictable it really is. The market doesn't hide its intentions, it just doesn't announce them either. And once you've trained your eye, you'll stop chasing the moment when it's already too late and start riding alongside the money that was there first. The pros aren't louder, they're quieter. They don't show their hand in the breakout. They leave footprints in the chop. And the sooner you learn to follow them, the sooner you stop being the exit liquidity they've been feeding on all along. Chapter 6. The Liquidity Mirage. How price gets pulled to the trap. Ever notice how price feels like it's magnetized to certain levels, only to whip the other way the moment it touches them? That's not randomness. That's liquidity doing its job, pulling you in, setting the trap, then snapping shut before you know what happened. Markets don't move because of your chart patterns. They move because big players need counterparties. Imagine a magnet hidden under a table pulling a coin across the surface. You can't see what's underneath, but the coin keeps drifting toward the same spot. Liquidity zones work the same way. Retail sees support, resistance, breakouts, and round numbers. Institutions see pools of stops and orders waiting to be harvested. And when enough orders pile up at one of those obvious levels, Price doesn't just wander there by coincidence, it gets dragged in like metal to a magnet. The problem is that when price approaches, retail thinks it's proof of strength in that direction. Price surges toward $100 or yesterday's high, and everyone screams breakout. But what's really happening is a liquidity grab. The moment stops are triggered and breakout traders pile in, institutions flip the switch. They use that manufacturer demand to fill their real orders, and the second they're done, price rips back the other way, leaving you trapped and bleeding. I watched gold do it in August 2022. It hovered near $1,800 for days, volume quietly building just below that big round number. Then, out of nowhere, it sprinted from $1,795 to $1,800 in 3 minutes flat. Retail saw breakout, but the institutions were already waiting. They dumped into that surge of buy stops, filled their sells, and within 15 minutes, gold was back at $1,790. To the crowd, $1,800 was the green light. To the pros, it was dinner time. You can see the mechanics if you know where to look. First comes the pull a sharp, almost unnatural sprint into the level. Straight line candles with no context behind them. Then comes the trigger stops and breakouts hit in one violent burst. And then the flush price reverses instantly, often harder than the approach. Because once the liquidity has been harvested, there's nothing left to keep pushing in that direction. It's the same dance every time, and it works because of confirmation bias. Traders already believe the level matters. When price races toward it, that belief hardens into certainty. They click buy or sell without hesitation, never realizing they've just volunteered as exit liquidity for someone bigger. The trick isn't to avoid these levels, it's to flip how you see them. Instead of treating them like invitations, treat them like traps. Map out the obvious highs, lows, and round numbers before the session. Watch how price approaches. If it drifts calmly, maybe there's something real. But if it accelerates like it's being sucked in, wait for the flush. Let it spike, let the stops get taken, then watch the rejection. That's your cue. I saw it play out on Nasdaq Futures one Thursday morning. Price hovered 50 points below the prior day's high, the perfect liquidity pool. It sprinted the distance in 4 minutes, blasted through the level, triggered every breakout order on the book, and then collapsed 70 points in the next 20 minutes. Anyone who recognized the mirage could have shorted into that rejection with almost no risk and walked away with 3 times their money before lunch. Once you start tracking these zones, you'll realize most of the random reversals that wrecked you weren't random at all. They were engineered magnets designed to bait you into doing exactly what institutions needed. And the deeper you look, the more obvious it becomes. The cleanest setups happen when multiple mirages align the round number that also happens to be a prior high that's been tested all week. That price suddenly spikes into on thin volume. That's not the market offering you a gift. That's the market begging you to bite. But if you flip the script, if you wait for the flush instead of joining the rush, you stop being prey. The market doesn't chase levels because they're magical. It chases them because that's where the food is. The day you start thinking like a hunter instead of a target is the day liquidity stops being your enemy and starts becoming your edge. Chapter 7. The New Spike Game. How headlines become liquidity weapons. You think news moves the market? The truth is harsher. The market moves the news, or at the very least, uses it as the perfect cover to move against you. It plays out the same way every time. An economic report is set for 8:30 in the morning, NFP, CPI, a Fed decision, doesn't matter. Retail traders gather like moths to a flame, eyes glued to the screen, waiting for the number to drop. The clock ticks, the headline flashes, and price explodes 50 points in one direction. Adrenaline surges, everyone rushes in, and then slam. Just as fast, the move reverses, wiping out anyone who chased the spike. To the crowd, it looks chaotic, even random. To the institutions, it's just another page in the playbook. News is the perfect weapon because it guarantees participation. Everyone's watching the same thing at the same time, which means liquidity is at its absolute peak. It triggers emotions instantly, no analysis, no patience. just fight or flight as traders hammer the buy or sell button. And when institutions want to move price aggressively, they get to hide behind the headline. Whatever direction they push, they can blame it on the news, even if their real goal is nothing more than loading or unloading positions. The trap works in two stages. First comes the spike, that violent, almost reflexive move in the seconds after the release. It looks like momentum, but it's really just a sweep, a way to trigger stops and bait breakout traders. Then comes the true move, the reversal, the part where institutions use the liquidity from retail's panic to position in the opposite direction. If you've ever wondered why price rips one way on the number, then erases it just minutes later, this is why. September 2022 made it plain. Non-farm payrolls printed slightly stronger than expected, and as P futures ripped 30 points higher in the first 15 seconds. Retail piled in, convinced the number justified the breakout. 90 seconds later, the entire move was gone, and the market was 50 points lower. That first spike wasn't opportunity, it was bait. The reversal was the real move, and only those who waited saw it. The psychology is brutal. Headlines trigger herding bias. When you see a chart and a crowd reacting at the same time, your brain assumes the crowd must be right. The speed of the spike convinces you there's no time to think, only to act. And that urgency is exactly why institutions love these moments. They get maximum participation from traders at their most vulnerable. The antidote isn't complicated, but it demands discipline. Never trade the first minute. Let the spike play out. Mark the extremes, the high and low of those chaotic first few minutes, and watch. If price breaks one extreme but snaps back instantly, that failed breakout is your real signal. Trade against it with your target set at the opposite side of the range. It sounds simple, but it works because you're not fighting the news, you're trading the reaction to the trap. I saw it in December 2021 during Powell's FOMC press conference. The S&P spiked 45 points higher in 2 minutes. Retail went all in. 10 minutes later, the market was 60 points lower. Later tape analysis showed it clearly. Institutions unloading massive sell orders right into the surge of retail buying. To the headlines, it was Powell's words. To the tape, it was just distribution in disguise. The edge doesn't belong to the fastest trader. It belongs to the calmest. While everyone else is reacting to the flashing numbers, the disciplined trader waits. They measure. They let the first wave pass. And when the reversal comes, they step in with tight risk and high probability, trading not the noise, but the pattern within the chaos. And make no mistake, there is a pattern. Backtests show it again and again. 70 to 80% of major scheduled news events create a false first move, only to reverse within 3 to 5 minutes. It's not random. It's human psychology on repeat. Once you've seen it enough, you stop fearing the spike and start using it. You lock the events, you mark the extremes, you wait for the break that fails, and slowly, news stops being a source of anxiety. It becomes just another hunting ground. Because the news itself doesn't create opportunity, it only reveals it. But only for the traders disciplined enough to wait for the trap to spring. The rest will always chase the headline, and the headline will always lead them straight into someone else's pocket. Chapter 8. The Overnight Illusion. How after-hours moves set the trap for the next day. Most traders sleep through the most important part of the trading day, the hours when the market quietly builds the traps you'll walk into tomorrow. You close your charts at 4 p.m., the bell rings, and you assume nothing meaningful happens until the next open. But that's the deception. Overnight is when institutions get to work. With liquidity thin and retail gone, they can push price with far less capital, painting pictures on the chart that will anchor your thinking before you even sip your first coffee. The calm of overnight sessions is deceptive because it's engineered. A 30-point move in the S&P during low liquidity feels like strength or weakness, but in reality, it's just bait. Institutions can quietly build positions without you noticing, then dump those same positions on the flood of retail orders that pour in at 9:30. That's why the open so often feels like a trap, because it is. The gap open is the clearest example. Price drifts higher overnight, opens well above yesterday's close, and retail interprets it as bullish momentum. They rush in at the bell, thinking they're catching the start of a trend. But the institutions, they were already long in the night session. Now they're unloading into the surge of morning buyers, locking in profit while retail becomes the exit liquidity. By the time the gap closes, the trap is sprung. It works the same in reverse with gap downs. Fear takes over, retail dumps their positions into the very hands waiting to buy from them. On June 14, 2022, it played out in textbook fashion. S&P futures rallied 35 points overnight with no catalyst. The market opened strong, retail piled in, and within 45 minutes, the entire gap had vanished, price sinking below the prior day's close. The buyers at the open thought they were chasing strength. In truth, they were just providing liquidity for the overnight longs to cash out. The trick extends beyond US hours. While American traders sleep, Asia and Europe set the stage. Asia often spends the night session grinding in tight ranges, but those ranges define the boundaries that Europe loves to break. And more often than not, the US session simply reverses the European breakout. Asia lays the groundwork, Europe fakes a move, and America punishes whoever took the bait. The pattern repeats so often you can mistake it for law. Learning to read the overnight footprint changes the game. The highs and lows carved while you sleep aren't random noise, they're a magnet. The size of the gap matters too. Small gaps tend to fill quickly, while large ones can reverse with violence once morning liquidity floods in. And volume is the tell. Was the overnight move built on strong activity, or was it just manipulation in thin markets? When you overlay global indices like the DAX or the Nikkei, the picture sharpens further. What looks like a US breakout can reveal itself as nothing more than a reaction to European positioning. The simplest way to weaponize this knowledge is to fade it. When you see an exaggerated overnight move, don't chase it. Wait for the open, watch the rush, and then fade it once exhaustion shows. The overnight illusion isn't just a trap, it's a springboard. And when you learn to flip it, you stop being the liquidity and start feeding off it. September 2021 gave us the perfect example. Nasdaq futures bled 120 points during the thin Asian hours, painting fear across the chart before most traders were even awake. At the open, retail panicked into shorts. 15 minutes later, the bottom was in, and by late morning, Nasdaq was up 180 points from the open. The overnight drop wasn't a trend. It was a discount sale for institutions who knew exactly how retail would react at the bell. If you want proof, run the experiment yourself. For 20 days, mark the overnight highs and lows, track the gap, and note what happens in the first 30 minutes of US trade. Patterns will jump off the chart, gaps that fill, European moves that fade, and overnight extremes that reverse almost on schedule. You'll realize most of the chaos you thought was random was actually scripted while you slept. And the psychology is simple. Overnight moves exploit anchoring bias. You wake up, see a market up 40 points, and your brain locks onto bullish day ahead. That number becomes your reference point, whether or not it means anything. Institutions know you'll anchor to it. That's why they set the stage at night, so when you step in at the open, your bias is already working against you. The truth is, if you only start paying attention when the bell rings, you're entering a story that's already been written. The overnight tape holds the prelude, the setups, the traps. If you ignore it, you'll always be reacting to a narrative you don't understand. But if you learn to read it, you'll stop being surprised by the morning moves, and you'll start using them for yourself. Because the market doesn't sleep. It just hides its intent where most traders refuse to look. Chapter 9. The Indicator Illusion. Why your tools keep you one step behind. If your chart looks like a Christmas tree, it's probably because you're trying to solve a speed problem with slow tools. Indicators seduce every new trader. They feel safe. MACD flashes a crossover. RSI tells you when the market is overbought or oversold. Moving averages draw neat little paths that promise clarity. It feels objective, almost scientific, as if you've built a system immune to mistakes. But the truth is harsher. Every indicator you rely on is built on the past, not the present. By the time it tells you what's happening, it already happened. Take something as simple as a moving average. A 50-period MA on the 1-hour chart is nothing more than the average of the last 50 hours of price. By definition, it lags. RSI, stochastic, MACD, same story. They aren't windows into the future. They're mirrors of what's already gone by. And while you wait for those mirrors to flash green or red, the real move is often already halfway over. You're chasing shadows, not trading truth. That lag bleeds traders dry. You buy after the surge because your MACD finally confirmed it, and then watch price retrace right back into your stop. You sell into weakness because your oscillator finally flipped bearish, only to see the market reverse the moment you're out. It's not that the indicator is wrong, it's just late. Institutions know this. They count on it. When a wave of retail traders piles into the same textbook crossover, pros are unloading into that surge, leaving you holding the bag. One trader I knew fell for it repeatedly. He saw a bullish MACD crossover on the daily, jumped in with conviction, and felt vindicated when the first candle closed higher. But the crossover had appeared after an 8% rally was already in the books. 2 days later, the pullback erased 5%, stopped him out, and the institutions who sold into that signal were long gone with his money in their pocket. That's how the trap works. The irony is that professionals use indicators too, but not the way retail does. They don't treat them like green light, red light triggers. They treat them like supporting evidence, context to confirm what they already see in price, volume, and order flow. An RSI reading above 70 isn't an automatic sell to them. It's a cue to ask, is this strength real or is it manufactured? They let price lead and indicators follow. The deeper danger of indicators isn't the lag itself, it's the false sense of certainty they provide. A colored line crossing another line feels authoritative, as if you're outsourcing the hard decision to something more objective than your gut. It exploits authority bias. You trust the math because it looks complex, even though the math is just averaging old numbers you could see with your own eyes on the chart. That's why so many traders stop thinking critically once the tool flashes its signal. The real breakthrough comes when you strip the chart bare. No RSI, no MACD, no rainbow of averages. Just price, structure, and volume. For 2 weeks, you force yourself to see the story without the crutches. Where's support being defended? Where's resistance cracking? How does volume confirm or deny the move? Then, and only then, you can add a single indicator back, not to trigger you into trades, but to confirm what you already suspect. And if you can't explain exactly how it calculates its value, you don't deserve to trade with it. I had a student named Mark who spent years stuck on the 20 EMA crossover system. His results were flat at best. When I told him to flip his process, read the market first, use the EMA only to confirm, everything changed. Within 3 months, his win rate jumped from 42% to 57% without touching his risk rules or setups. The only difference was that he stopped outsourcing his decisions to a lagging tool and started letting the market lead the conversation. Indicators aren't evil, they're just misunderstood. They were never designed to predict, they were designed to summarize. Price is the headline. Indicators are the footnotes. And if you make the footnotes your story, you'll always be behind the traders who learn to read the raw language of the market itself. The ones who win aren't staring at a Christmas tree. They're staring at clean charts, waiting for the tape to reveal its hand in real time. And that's why they're always a step ahead, because the truth is simple. If you trade the footnotes, you'll miss the plot. Chapter 10. The Candle Deception. How a single bar can tell the wrong story. You think one candle tells the truth? It can lie to you as easily as a magician's sleight of hand, and the trick works because you want to believe it. Every trader has felt the pull. You see a giant bullish engulfing bar print on your chart, you feel the adrenaline spike, the FOMO kicking in, you buy, and within minutes, the same candle that looked like your ticket to easy profit gets erased as price turns violently against you. That bar didn't reveal the market's intention, it revealed the market's illusion. Candles deceive because they tell an incomplete story. A single oversized bar might look like strength, but it could just as easily be a stop hunt or a liquidity grab. The smaller the time frame, the worse the distortion gets. A candle that looks explosive on the 5-minute chart might vanish into insignificance when you zoom out to the daily, nothing more than a flicker inside a dominant downtrend. And yet, your brain latches onto it, because large candles create visceral reactions. Their color, their size, the way they engulf previous price action, it all anchors your emotions and overrides your logic. I watched it play out with painful clarity in March 23 when Euro USD printed a massive bullish engulfing candle right above key support on the 15-minute chart. Retail traders piled in long, convinced they spotted the reversal. Within half an hour, the entire candle was erased and the market broke lower. That engulfing bar wasn't strength, it was a trap. Nothing more than institutions sweeping liquidity before driving price in the opposite direction. The anatomy of these lies is always the same. Price creeps toward a key level, building anticipation. Suddenly a surge rips through, forming a candle that screams momentum. But as soon as the orders are absorbed, the flip happens. Price reverses, and everything that candle seemed to promise evaporates. It works so well because of our wiring. Human brains are addicted to patterns. A hammer candle at the bottom of a downtrend feels like salvation. A pin bar rejection feels like confirmation. But those familiar shapes aren't always the market's truth. They're often just the bait institutions use to draw retail in. The only way to defend yourself is to stop treating a single candle as gospel. One bar means nothing without context. If the volume is high but the follow-through dies instantly, it's manipulation, not conviction. If that bullish candle is forming inside a weekly downtrend, it's probably noise, not reversal. And if you can't wait for the next 2 or 3 candles to confirm the move, you're just trading hope. I'll never forget the Bitcoin pin bar trap in July 2021. A textbook bullish pin bar formed after weeks of selling, and crypto Twitter lit up with calls for the bottom. The very next day, BTC fell another 8%. That pin bar wasn't strength, it was just a short cover rally in thin conditions, an illusion mistaken for intent. Professionals know better. They never trade a candle in isolation. They demand alignment across timeframes. They want volume to confirm, and they wait for follow-through. They use candles not to decide direction, but to fine-tune timing inside the broader story. A wide bar blowing through a level on thin liquidity? They fade it. A narrow continuation bar with heavy volume inside a clear trend? They join it. They're not reading the candle as truth, they're reading it as context. For most traders, the fastest way to cut through the deception is simple. Start saving every chart where a candle triggered your emotions. Mark the higher time frame trend, the volume, and what happened in the next 3 bars. Review them after a week, and you'll see the pattern. The candles that scream loudest are often the ones that reverse the hardest. The bars that look boring at first glance were the ones that carry the real signal. That's why pros don't get hypnotized by one bar. They look for absorption candles, where price probes into liquidity and snaps back. They watch for stop-run candles, where a wide range with instant rejection exposes the trap. They know the difference between a candle that's printing a story and one that's printing a lie. Because in the end, candles are just the market's language, and language can mislead as much as it can inform. If you read the words without understanding the story, you'll always be chasing shadows, always reacting to illusions painted by bigger players who know exactly what you're taught to trust. The market doesn't need you to misread those shapes. It wants you to, and that's why one candle never tells the truth, not by itself. Chapter 11. The Breakout Mirage. Why most breakouts fail and how to catch the few that run. If you've ever bought a breakout only to watch it collapse minutes later, you've already met the mirage, the market's cruelest trick. It seduces you with hope, then makes you pay for chasing it. The allure is irresistible. Price finally pushes above resistance, volume spikes, social media lights up, and it feels like confirmation. You smash the buy button, convinced you're catching the start of the big run. But within minutes, you're in the red, staring at the reversal you never saw coming. That wasn't a breakout. It was bait. Most breakouts fail because they aren't designed to reward retail. They're designed to harvest liquidity. The instant price pokes above resistance. Shorts panic and cover while breakout traders flood in with new longs. That sudden burst of demand is exactly what institutions are waiting for. They sell into it, unloading inventory at premium prices. while you and 1,000 others celebrate what looks like the real move. The more obvious the level, the more likely it's been stalked by big players for days, waiting for the moment the crowd hands over their liquidity on a silver platter. Tesla gave a textbook lesson in April 22. Price ripped through the $1,000 barrier with massive volume, the kind of clean breakout that fills every retail trader with euphoria. For a few minutes, it looked unstoppable. By the close, Tesla was back under 1,000, finishing the day at $980. Nothing was wrong with the breakout. It worked perfectly, just not for the people chasing it. Institutions sold into the surge, pocketing profit while retail got trapped. The anatomy of these failures is always the same. Price coils just under resistance, building tension. A sudden push sends it flying through the level. For a heartbeat, it feels like liftoff. Then comes the dump. Big sellers absorb all that new demand and drive price straight back into the range. The emotional swing from euphoria to panic is where the pros find their edge. The psychology is brutal. Breakouts trigger confirmation bias and FOMO at the same time. You'll see the level break and take it as validation of your bias, while the speed of the move convinces you to act before you miss it. That urgency is the fuel institutions need to spring the trap. I remember it vividly with Euro USD in late 21. After weeks of sideways action, the pair finally broke above 1.1500, a round number everyone was watching. Retail cheered. Within 2 hours, price had collapsed to 1.1460. The breakout was nothing more than a liquidity grab, a false move before a multi-day sell-off. Retail saw a breakout. Institutions saw a cluster of stops to sell into. The truth is, most breakouts don't run. They collapse, and their failures are often more profitable to trade than the breakout itself. The best move isn't chasing the push, it's fading it. Wait for the false break, watch for the rejection back inside the range, and step in the opposite way with your stop just beyond the trap. The Nasdaq gave a perfect example on March 2023, breaking above intraday resistance at 12,300 before snapping straight back down. Anyone who faded that failed break walked away with a 4-hour short into the session lows within hours. If you start tracking them, you'll notice the same thing. Most breakouts don't last more than a few bars unless institutions are backing them. And that's the filter that separates the mirage from the real deal. True breakouts align with a higher timeframe trend, build volume into the level before they break, and hold above the breakout line when tested. Mirage breakouts don't. They sprint up thin, fail instantly, and die in the same place they began. Breakouts are not created equal. The market teaches you to chase them. The pros make their living fading the ones you can't resist. The sooner you stop playing the prey, the sooner you'll see what the breakout really is. Not an invitation to join the move, but a trap to fuel the opposite one. And that's the mirage. Chapter 12. The Volume Illusion. When big spikes mean the opposite of what you think. Retail traders love volume spikes. They see the big surge in activity, the bars towering above the average, and think, momentum, the move is real. But more often than not, those spikes aren't the beginning of a new leg, they're the end of one. The myth runs deep because almost every trading book teaches the same thing. Rising volume confirms a trend, big spikes mean strong participation, volume validates a move. It sounds logical, almost scientific. But the reality is harsher. Those surges in activity usually appear when the move is already exhausted, when everyone who wants in has already piled in, and institutions are quietly slipping out the back door. Crude oil in March 2022 told the story perfectly. After weeks of relentless rallying, price spiked to $130, breaking out into fresh highs. Volume exploded to levels not seen in years. To retail, it looked like liftoff. But within days, oil was under 110. That volume wasn't new money joining the rally, it was old money unloading positions into the euphoria. The spike marked the top, not the start. This is how false volume signals unfold. A market extends for days or weeks, stretching traders' patience. Then a catalyst hits, maybe a headline, maybe a round number, and suddenly the floodgates open. Participation surges, volume explodes, and retail interprets it as confirmation. But that burst is often just the final gasp, the climax before reversal. Institutions use the frenzy as camouflage to distribute their inventory into retail's confidence. The psychology is simple. Spikes trigger the bandwagon effect. If everyone else is rushing in, you feel safer joining them. It validates your bias. But in markets, that comfort usually means you're the last one in and the first one trapped. Apple gave another clean example. After climbing from $140 to $155 in just 2 weeks, volume suddenly exploded on day 14 as price pushed into $157. Social feeds buzzed with bullish conviction, traders loaded up, and then the next 2 sessions erased the entire move, dragging price back to $150. That surge of participation wasn't strength. It was a perfect exit for institutions unloading into the crowd. This is why volume has to be read in context. A spike early in the move, backed by higher time frame structure, can signal genuine accumulation. But a spike after an extended rally, that's exhaustion more often than not. The key is how price reacts after the spike. True institutional buying holds the level or builds on it. Distribution rejects hard, flipping direction almost immediately. For traders who know how to read it, this opens a high probability play. Spot the spike, wait for rejection, and fade the move with tight risk. Often, price will unwind straight to the nearest support or resistance as trapped traders scramble to exit. The beauty is in the efficiency. The reversal is usually fast and violent, because the same traders who bought into the spike are now forced to puke their positions out. But the most advanced edge doesn't come from raw volume at all, it comes from breaking it down. Footprint charts and delta analysis show who's behind the aggression. If volume spikes but delta is negative, it means sellers dominated that candle despite all the activity. That's a bearish tell, a sign distribution is happening under the hood. On the flip side, if volume surges with strongly positive delta in the early stage breakout, institutions may actually be pressing the move with real intent. That's the difference between following the crowd and reading the tape. Volume isn't your enemy, but it isn't the golden compass you were taught it was either. Spikes aren't automatic green lights. They're signals that demand interpretation. The question isn't how much volume. The question is always who's on the other side of it. And once you start asking that question, you stop chasing the final burst and start trading the turn. Chapter 13. The Correlation Trap. When related markets lead you into a losing trade. You think if the S&P is green, your stock has to rise too? That belief is one of the fastest ways to bleed slowly in this game, because correlations are the market's most seductive lie. They make everything feel logical. Oil spikes, so energy names should rally. The dollar dips, so gold should pop. Nasdaq runs, so tech should pump. It feels like you've cracked the code, like there's a roadmap baked into the tape. But the truth is uglier. Correlations are not fixed. They're fluid. They breathe, they shift, they invert without warning. And if you're still trading last week's correlation, you're already behind. Gold and the dollar exposed that lie in 2020. For months, the relationship was clean dollar down, gold up. Traders built entire playbooks on it. Then September hit. The dollar rolled over hard, and retail rushed to buy gold, expecting the usual dance. Instead, gold dumped. What changed? Real interest rates, not the dollar, became the dominant driver. The correlation snapped, and anyone who assumed it was permanent got blindsided. That's the trap. Your brain craves continuation, the idea that what worked yesterday must still work today. It's pattern recognition bias, the same instinct that makes you see shapes in clouds. But in markets, that instinct turns deadly, because it tricks you into believing a relationship is stable when it's already decaying. Institutions don't fall for this. They never assume. They measure. They track rolling correlations across multiple timeframes, constantly updating. They know the S&P and crude might move in lockstep on the 90-day window, but intraday they could be dancing to totally different songs. They watch which market is leading and which is lagging, because one always sets the tone while the other reacts. And when the relationship breaks, pros aren't shocked. They're ready to fade the laggard while retail gets whipsawed. April 23 showed the lesson again in crude oil. Futures ripped 5% in 2 days, and retail piled into energy stocks expecting them to catch up, but the stocks stayed flat, refusing to confirm the move. That was a tell. Oil reversed violently, and those lagging equities didn't catch up, they collapsed. The clue was there the whole time. When the follower fails to follow, it's not confirmation, it's warning. So how do you use correlations without letting them bury you? First, stop treating them as trade triggers. They're not signals, they're context. A strong correlation can confirm your bias, but it should never be the reason you pull the trigger. Second, learn to see them as tools, not rules. Sometimes they're best used for hedging risk, sometimes for spotting divergences worth fading, but they're never a crutch. And if you want the sharpest edge, combine correlation analysis with order flow. When correlations start to break, look under the hood. If gold stops following the dollar and you see heavy accumulation in the tape, that's not noise. That's gold preparing to run on its own. That's the moment where pros step in while everyone else argues that it shouldn't be moving like this. Correlations are like weather patterns. They hold until they don't. If you treat them as permanent, they'll drag you into storms you never saw coming. But if you measure them, question them, adapt when they shift to you, stop chasing yesterday's playbook, and start trading the market that's actually in front of you. Because the truth is simple. Correlations don't owe you anything. And the moment you treat them like guarantees, the market will remind you just how expensive that belief can be. Chapter 14. The Time Stop Lie. Why holding for a minimum time can kill your edge. Ever heard the advice? Just let your trade breathe, hold it for at least 15 minutes, an hour, whatever? On paper, it sounds like discipline. In practice, it's one of the most expensive lies you can follow. The whole idea comes from a well-meaning place. New traders cut winners too fast, bail the moment a candle wiggles against them, or scalp themselves out of setups that could have run. So gurus preach a time rule. Give every trade room to play out. Don't get shaken by noise. Sounds logical, but the problem is simple. The market doesn't move on your clock. The second you tie your exit to time instead of conditions, you've put yourself in a straitjacket, and the market loves squeezing traders who can't adapt. Picture this. One NASDAQ trader had a system that required holding trades for a minimum of 15 minutes. Within a single week, he had 3 trades up more than 2R within 5 minutes. By the time his timer dinged, all 3 had reversed to red. The rule didn't protect him, it turned wins into losses. Not because his entries were bad, but because he let a stopwatch, not the chart, dictate his exits. That's the real poison. A time stop feels like discipline, but it's actually stubbornness dressed up as structure. It taps into commitment bias. Once you've promised yourself, I won't exit before 10 minutes, you feel obligated to stick to it, even when the market is screaming that your edge is gone. You're not being patient, you're being trapped. Pros don't play that game. Their exits aren't measured in minutes, they're measured in conditions. Price invalidates the setup, they're out. Momentum slows, order flow dries up, VWAP rejects, they lock profits before the rug pulls, and when momentum is alive, they'll hold not because the clock says so, but because the fuel is still burning. A scalper in Euro USD nailed this perfectly. Entered long on strong order flow, watched momentum readings collapse 3 minutes later, exited with plus 1.8R in the bank. 2 minutes after that, the whole move was gone. No timer needed, just reading the tape. That's how you replace the lie of a time stop with the truth of a condition stop. Define where the trade idea stops making sense. That's your real stop. Define what success looks like. That's your target. Sometimes that'll take 30 seconds, sometimes 3 hours. The market decides, not your wristwatch. If you want to see how badly the clock has been bleeding you, run a time audit. Track the duration of your next 20 trades. Note whether earlier exits would have saved you, or whether holding longer actually came from valid structure or just stubborn waiting. Most traders discover the same ugly truth. The clock cost them money, not saved it. For a sharper edge, tie your patience to volatility instead of time. Fast markets, take your profits faster. Slow markets, let them grind. This way, your hold adapts to the market's pace, not some arbitrary number you picked up in a trading room forum. Because here's the bottom line. The market doesn't reward loyalty, it rewards accuracy. Stay in the trade until the reason for being in, it disappears, not until your stopwatch says you've been disciplined enough. Chapter 15. The risk-reward illusion. When chasing perfect R multiples hurts your win rate. You've been told to only take trades with 3-to-1 risk-reward. It sounds professional, disciplined, smart. But in practice, that rule has quietly sabotaged more traders than it's ever saved. The origin of the 3-to-1 mantra is simple math. Risk $1 to make $3. And even if you're wrong most of the time, you'll still come out ahead. On paper, it looks bulletproof. In reality, markets don't hand out clean 3R setups every day, and forcing them is where the trap begins. Here's why. When you ignore market context, you end up holding trades into walls of support, resistance, or liquidity pools just because 3R hasn't hit yet. You lower your win rate by demanding bigger moves than the market is realistically offering. Worse, you skip perfectly valid 1.5R or 2R trades that could stack into consistent gains. What you call discipline is often just missing money. Take one ES futures trader who lived by the 3R rule. Over 3 months, he passed on dozens of clean 1.5 to 2R setups, endured long dry spells, and when winners finally came, volatility often knocked him out before 3R ever printed. His system didn't just underperform, it lagged a balanced approach by nearly 30%, not because his entries were bad, but because his target was divorced from reality. That's the illusion. The lure of the big payout taps into reward bias. We want the story of risking small to win big. It feels smarter, safer, even noble. But pros don't worship at the altar of fixed multiples. They use targets dynamically shaped by volatility, structure, and momentum. They take partial profits at logical points like 1R or 1.5R to lock gains, then let the rest ride when the path is clear. They don't force 3R on every trade. They let the market decide when it's possible. A gold swing trader proved this beautifully. She scaled half out at 1.5R, then trailed the rest. When the market only offered a small run, she banked. When it gave a bigger trend, she caught it. Over 6 months, her equity curve was not only smoother than the all-or-nothing 3R approach, it was bigger. Consistency won over fantasy. The balanced R approach is simple. Identify targets based on what's actually on the chart, not arbitrary multiples. Take partials where reactions usually happen. Let runners work only when price has room to run. That way, you're playing both sides of the game, probability and payoff, instead of sacrificing one for the other. If you doubt it, audit your last 30 trades. Write down the actual R you achieved. Count how often 3R was hit compared to quicker targets. Then compare your equity curve volatility between a rigid 3R only strategy and a flexible, context-driven one. Most traders discover the same ugly truth. The obsession with 3R made them less profitable, not more. For an advanced edge, tie your targets to volatility itself. Use ATR average true range to size exits relative to current market pace. Maybe first scale at half an ATR, then take more at 1 ATR, and keep a runner for 2 ATR or more. That way, you're not asking the market for something it can't give. You're aligning with what it's already offering. Because here's the final truth. Risk-reward isn't about chasing the biggest number. It's about finding the balance between probability and payoff. Perfect math means nothing if the market can reach your target before it takes you out. Chapter 16. The Journal Illusion. When tracking your trades makes you worse. Everyone tells you to keep a trading journal, and you should. But here's the brutal truth. If you're doing it wrong, your journal isn't making you better. It's just a diary of repeated mistakes. Most traders think journaling equals improvement. They log the entry, the exit, maybe scribble a line like, good setup, just unlucky. Then they close the file, pat themselves on the back, and feel disciplined. But nothing changes. Why? Because they're tracking the wrong things. There are really two kinds of journals. The first is the record-keeping journal. dates, markets, screenshots, outcomes. It's accounting. Useful for taxes, useless for growth. Then there's the performance journal, the one that digs into why you took the trade, how you felt, and whether you actually follow your plan. That's the one that forces self-awareness. That's the one that hurts and helps. If your journal is just numbers and pictures, it's like weighing yourself every morning without tracking what you ate or how you trained. You're recording results with zero insight into causes. One trader I coach had 300 plus trades logged in Excel. Win rate 43%. Average risk to reward at 1.7. Net P slightly negative. On paper, he was diligent, but not a single note on emotions, setups, or rule adherence. He wasn't journaling, he was bookkeeping his way to nowhere. The trap works because journaling feels productive. It triggers completion bias. Check the box, feel accomplished. But without reflection, it's just paperwork. Professionals approach it differently. They tag trades by quality A+ setups, impulse trades, revenge trades. Over time, the money-making patterns stand out, and the costly ones get eliminated. They track emotional state, calm, anxious, overconfident. Because often the feeling before the trade predicts the outcome better than the chart. They grade rule adherence separately from the P&L. Was this a 9 out of 10 execution even if it lost? Or a 2 out of 10 discipline even if it won? And they force themselves to choose one improvement focus each week, not 10. One of my students was stuck at a 35% win rate. We added emotion tags, setup grading, and weekly reviews. Within 3 months, his win rate hit 56%. Same strategy, same markets. The only difference was accountability in the journal. Here's how you upgrade yours. For the next 20 trades, log the setup grade. A, B, C, your emotional state before entry, and one thing you could have done better. At the end of the week, don't admire your notes, pick one focus to attack next week. That single thread of improvement compounds faster than any list of random adjustments. To cut through noise, anchor on 3 questions after every trade. Did I follow my plan? Was the setup worth the risk? Would I take this trade again? If the answer to number 3 is no, the trade never should have existed. The real edge comes when your journal evolves from record keeping to pattern tracking. Recurring setups become your bread and butter. Recurring mistakes become your avoid at all costs blacklist. Suddenly, your journal isn't a graveyard of trades, it's a filter for your future. Because in the end, a journal is a mirror. If you only log what happened, you'll keep repeating it. If you're honest enough to log why it happened, you'll finally start changing it. Chapter 17. The Over-Optimization Trap. Why constant tweaks destroy consistency. You think you're refining your system, but really you're just moving the goalpost and destroying your ability to trade with confidence. It starts innocently. You take a string of losses. You tell yourself the system is flawed, so you change your entry trigger. A week later, you're still bleeding. You swap indicators, tweak stops, stretch targets. A month goes by and you've stitched together 3 half systems and mastered none. This is the endless tweak cycle, the place where traders live when they mistake reaction for refinement. Why does it happen? Losses trigger recency bias. The last 5 trades feel more important than the last 50, so you overreact. Tweaking creates the illusion of control. It feels like progress, even though you are just avoiding the discomfort of admitting execution flaws. And worst of all, you confuse strategy problems with self-problems. The system didn't fail, you just didn't follow it with precision. I coached a trader who changed systems 5 times in 6 months. Every backtest looked brilliant in hindsight. Every live run collapsed. The issue wasn't the strategies. It was that he never gave any of them enough time to prove whether the problem was the rules or the trader following them. The trap works because of shiny object syndrome, the belief that the next adjustment will be the one. But in trading, constant change doesn't sharpen an edge, it dilutes it. Pros know this. They draw a hard line between testing and trading. If they're forward testing, they commit to a sample size 50, 75, 100 trades before making a single adjustment. They follow the data threshold rule. No changes until you've gathered enough trades under identical conditions. And when changes do happen, it's one variable at a time, stops or targets or entries never all at once. One futures trader I worked with committed to 90 trades without a single tweak. By trade number 40, his win rate stabilized. By trade number 65, his equity curve turned positive. By trade number 90, his confidence was unshakable because he finally knew what was system flaw and what was execution flaw. That's how you refine. Log the core rules, set a review date, and only test adjustments after they've been proven. If a brilliant new tweak comes to mind, mid-cycle, park it in a document. Don't touch it until the sample is complete. If curiosity eats at you, scratch the itch in parallel. Run the new idea in backtest or demo while your live account stays disciplined on the current plan. That way, you explore without sabotaging consistency. Here's the bottom line. A good enough system executed with consistency will always beat a perfect system that keeps changing. If you're always fixing your method, you'll never fix your discipline. And in trading, discipline is the only edge that lasts. Chapter 18, the overconfident spike. How winning streaks set you up for the biggest falls. Most traders fear losing streaks, but the real danger? Winning streaks. Because you don't see the risk until you're already falling. It starts small. 5 trades in a row go your way. The equity curve climbs, confidence surges. At first, it feels earned the reward for discipline. But beneath the surface, something shifts. You stop trading with caution and start trading like you can't miss. That's when the cracks appear. The danger of a win streak is subtle. Risk creeps up, you bump size a little because there's cushion, marginal setups sneak in, my read is on fire, I'll take it. Ego edges in wins feel like proof you're smarter than the market. Respect for process fades. One trader I worked with hit 7 straight winners on Nasdaq futures in a single week. By trade 8, he doubled size. By trade 9, he broke rules. By trade 10, he was chasing to win back what he just lost. Within 3 trades, half the week's gains were gone. By month's end, the account was negative. The streak wasn't the victory. It was the setup for the collapse. This is pure overconfidence bias. The brain confusing recent success with permanent skill. You overestimate yourself, underestimate risk, and start trading your ego instead of the market. Pros treat streaks differently. They build protocols. After 4 or 5 wins in a row, size gets cut for the next few trades. Setups need stricter validation, no B ideas, only A+ conditions. Some even step away for a day, review the streak, and ask, was it true skill or just favorable market conditions? They trade less aggressively after winning, not more. One prop trader I mentored had a simple rule. After 4 consecutive wins, all trades for the next week stayed at baseline size, no exceptions. It killed the temptation to press the luck. His equity curve never spiked as violently as others, but it also never collapsed. The line kept climbing. The deadliest thinking after a streak is the house money illusion. Traders justify bigger bets because they're playing with profits. But the market doesn't care. It's not house money, it's your money. And it disappears just as fast when you stop respecting it. If you want to protect yourself, create a streak protocol. Define your threshold, maybe 4 wins in a row. When you hit it, automatically reduce size by 25 to 50% for the next 3 trades. Demand double confirmation on entries. Don't loosen your rules, tighten them. And here's the advanced edge. Backtest your trades segmented by what happened after streaks. You'll probably see your win rate drops after consecutive winners. That data alone will prove why you need controls when things are going well. Because here's the truth. A streak isn't just a sign of skill. It's also a warning light. If you treat it as proof you can't lose, the market will happily remind you that you can. Chapter 19. The Market Revenge Fallacy. Why getting back at the market always ends the same way. You take a loss, heart rate spikes, your mouse hovers over the buy button. You're not analyzing anymore, you're plotting payback, and that's the trap. Revenge trading doesn't start with a chart pattern. It starts with a thought, I'll just win it back. But that thought isn't about opportunity, it's about ego. The moment your next trade is framed as payback, your goal has shifted. You're no longer trading the market, you're trading your pride. And it always unravels the same way. You rush in without full analysis, grabbing a subpar setup just to act. You bump your size because recovering faster feels smart, but bigger size also means faster ruin. Anger narrows your focus. You stop seeing warning signs that would be obvious on a calmer day. One trader I worked with took a minus 1.2 R hit on Euro USD. Instead of pausing, he doubled size on the next trade. Another minus 2 R. He fired again within 10 minutes, desperate to claw it back. Another minus 1.5 R gone. In under an hour, he'd blown over 10% of his account. Not because his system failed, because his ego hijacked the wheel. This is loss aversion in its purest form. The fact that losses sting twice as much as equivalent wins feel good. The pain of being down triggers the urge to erase it, and that urgency drives you straight into reckless setups. Pros don't let that loop start. They run rules that break the chain before emotion takes control. Some step away after any loss 15 to 30 minutes minimum, just enough to cool the emotional charge. Others use hard loss limits daily or weekly that shut trading down before tilt spirals. At one prop desk, the rule was simple: 2 consecutive losses and your session was over. That single guardrail cut average drawdowns by nearly 40%. The key is to break the cycle in real time. First, name the urge. I want this trade because I'm angry. Just saying it out loud makes it real. Then, change your environment. Stand up, walk away, shut the platform if you have to. Only once the emotion has passed do you look back at the trade objectively and ask, did I follow plan or not? Want a brutal but effective test? For the next 20 days, tag every trade you take within 15 minutes of a loss. Check if it actually fit your plan. Track the results. Most traders quickly see those are their ugliest performers, the ones wrecking equity curves. Pros also have recovery plans preloaded. Some paper trade until they string together 2 clean winners. Others cut size in half until they're back to break even. Most stick to A+ setups, only the ones that demand patience. What they don't do is win it, hoping emotion will fade on its own. Because here's the truth, the market doesn't know you exist. It's not your enemy. It can't be beaten, punished, or taught a lesson. The only person you fight when you revenge trade is yourself with your own capital. Chapter 20. The Final Edge. Shifting from outcome obsession to process mastery. Every trader says they focus on the process. But if your mood still swings with every tick of your PL, you're not process driven, you're outcome obsessed. And that obsession is silently eroding your edge. It shows up in subtle ways. You check your PL after every trade. You label setups as good or bad only by whether they made money. You cut winners too early just to lock in the green day. All of it ties your identity to randomness, the noise of short-term results instead of the signal that actually matters, execution. The problem? You can't control outcomes. Not the next candle, not the next trade, not even the next week. What you can control is whether you followed your rules, sized correctly, managed risk, and stuck to the plan. That's where consistency comes from. That's how edges play out. Not in the next 5 trades, but in the next 500. I once worked with a trader who had a perfectly fine system, 48% win rate, positive expectancy, but every time they hit a 3-trade losing streak, they tweak something. Indicators, targets, filters. The equity curve looked like a seismograph. We flipped the script. No more daily dollar targets. Instead, their only daily metric was 100% rule adherence. Weekly reviews were graded on process quality, not profits. 6 months later, nothing had changed in their system, but everything had changed in their results. Confidence rose, execution steadied, and the same method that once sputtered now printed consistent gains. That shift works because it breaks resulting bias, the trap of judging decisions by outcome instead of correctness at the time. Pros replace that with deliberate practice. Grade the execution, not the scorecard. The framework is simple. Redefine a good day as one where you followed your process perfectly, regardless of whether the market paid you. Track process metrics like rule adherence, setup quality, and emotional stability. Celebrate execution wins because cutting a loser at your stop is just as much a victory as banking a profit. do that, and your equity curve starts to smooth, not because the market changed, but because you stopped sabotaging yourself. The action step is brutal in its simplicity. For your next 50 trades, score yourself 1 to 10 on execution. Ignore PL until review day. Watch what happens. Almost always, high execution scores correlate with long-term profitability even if the short-term results look messy. For those ready to level up, commit to a 90-day process lock, trade the same rules without change, grade only execution, review only weekly. At the end, compare both PL and process. The shocker for most traders isn't just that their PL improved, it's that their emotional swings collapsed. Consistency in process creates consistency in mindset, and consistency in mindset creates consistency in results. That's the final loop. Plan, execute, review, refine, over and over until mastery takes shape. Because every chapter in this book, every pitfall and every trap points to the same truth. The market doesn't reward hope, prediction, or ego. It rewards repeatable discipline. Your edge isn't a setup, or an indicator, or a secret piece of information. Your edge is your ability to execute your process flawlessly, regardless of what the outcome throws at you. Shift your identity from a trader who makes money to a trader who executes. The money will come, the mastery will stay. Climax. The first time I realized the chart was lying to me, I felt betrayed. Not because I lost money, I lost plenty before, but because I had trusted it. Every candle, every breakout, every confirmation signal. I thought they were the market speaking to me, but they were someone else's script, and I was just a character in their play. Here's a brutal truth. The chart doesn't care about your dreams of financial freedom. It doesn't care about your strategy, your stop loss, or your perfect entry. It's not even neutral. It's a weapon. And unless you understand who's holding it, you're the target. We've spent the last 2 hours dissecting 20 psychological traps the market uses. From fake breakouts to volume illusions, from revenge trades to overconfident spikes, every single one has the same root cause. Your brain is wired to see what the market wants you to see. And the only way you win is when you stop reacting to the picture and start reading the story beneath it. Because that's what the pros do. They don't see red and green candles, they see motives. They see liquidity. They see the hands moving the pieces. And when you learn to do that, the market goes from feeling like a battlefield to feeling like a blueprint. Remember what I told you in the beginning? If you keep trading the picture, you'll keep playing someone else's role. But when you learn to trade the truth, you write your own ending. And that's the moment everything changes. Outro. The market will never get easier. It will never suddenly decide to show you the truth. And the moment you start waiting for it to be fair, you've already lost. But here's the good news, it doesn't have to get easier for you to get better. Because now you've seen the blueprint. Now you know the traps. Now you understand that every spike, every stall, every perfect setup is either bait or a breadcrumb. And you get to decide which one it is. The traders who last, the ones who grow accounts year after year, are not the ones who avoid losses. They are the ones who execute with discipline, adapt with clarity, and refuse to give the market their emotions. If this deep dive gave you just one moment where something clicked, if one of these 20 psychological shifts made you rethink your next trade, then imagine what happens when you commit to mastering all of them. So here's what I want you to do. Subscribe so you don't miss the next breakdown. We're going even deeper. Like this video if it gave you value, it tells me to make more of these for you. Comment below with the one insight you're going to apply in your very next trading session and read the other comments. You might just find your next breakthrough in someone else's reflection. Share this with a trader who's still blaming bad luck for their losses. You might save them a year of pain. You've got the knowledge now. All that's left is the discipline to use it. Because the market doesn't care about what you say you'll do. It only rewards what you actually do. I'll see you in the next one.